All right, let's talk about one of the most exciting and, let's be honest, one of the most confusing parts of working at a startup, your incentive stock options, or ISOs. They can be this incredible tool for building wealth, but man, they are complicated. So today, we're going to demystify them together.
So if you've ever gotten that offer letter with a huge number of options on it, you know that feeling, right? It's awesome. But then, a second later, this little wave of anxiety hits. How do these things actually work? And more importantly, what are the hidden tax traps that could totally blindside you? That is exactly what we are going to break down.
Okay, first things first, let's get the absolute basics down. An ISO isn't actually stock, not yet. It's the right to buy the stock at a price that's locked in for you. That's called the strike price. And that price doesn't change, no matter how valuable the company gets. And that little phrase at the end there, favorable tax treatment, that's the golden ticket. That's what can make a huge difference in how much money you actually walk away with.
Really, you should think of your ISOs as the heart of the startup deal. You're taking a chance on a company that's growing. And for that risk, you get the opportunity to own a piece of it at a major discount. This is your shot to get a real piece of the success that you're helping to build every day.
So, how does this actually make you money? Well, it's all about the gap, the spread, as they call it. As the company does well, its value, the fair market value, or FMV, goes up. But your price, your strike price, that stays put. The growing space between your low price and the company's high price, that's where your profit is. The bigger that gap gets, the more your options are worth. And here we are, our first really big decision point. You see, having the right to buy shares is one thing, but actually pulling the trigger and buying them, that's a whole other story. This is called exercising your options, and this is where things start to get really interesting and, yeah, potentially pretty expensive. Now, some companies offer this really powerful, kind of advanced strategy called early exercise. This means you can buy your shares before you've even earned them through vesting. We're talking right after they're granted, when the company's value is probably still pretty low. It's a bold move, for sure, but wow, it can have some massive tax advantages. Let's look at how.
So this creates a really fascinating trade-off, right? The huge benefit is that you start those all-important tax clocks ticking way sooner, which helps you qualify for those lower tax rates down the road. And if the value of the stock is the same as your strike price when you do it, you might pay zero tax right then. But what's the catch? Oh, there's a catch. You're paying real cash out of your pocket for shares you don't even fully own yet in a company that might not make it. And if you leave before you're vested, guess what? The company can just buy those unvested shares right back from you. And listen, if you decide to go for the early exercise, this next part is not a suggestion. It is absolutely non-negotiable. You have to file something called an 83B election with the IRS, and you have exactly 30 days to do it, not 31. This form basically tells the IRS, hey, I want to be taxed on this now, based on today's value, instead of later when the value and your tax bill could be astronomically higher.
Okay, whether you exercise early or wait until you're vested, there is a big, scary monster lurking in the tax code just for people with ISOs. It's called the Alternative Minimum Tax, or AMT. This is without a doubt the single biggest trap that catches people by surprise and can lead to a shocking, massive tax bill you never saw coming.
The AMT gets triggered by this really weird concept called phantom income. It's exactly what it sounds like, a gain that exists on paper, but you haven't actually seen a dime of it in cash. When you exercise your ISOs and decide to hold on to the shares, the IRS looks at that on-paper profit you just got and says, that looks like income to us, even though you haven't sold a thing.
Let's make this super simple. Imagine your company is just crushing it, and the stock is now worth $50 a share.
But you have your secret weapon. Your strike price is locked in at just $10 a share. You get to buy it for cheap. See that $40 difference? That is your on-paper profit. That's your bargain element. And for the purposes of the AMT, the IRS treats that as income. Now, multiply that by, say, 10,000 shares, and suddenly you have $400,000 in phantom income that could trigger an absolutely life-changing tax bill. And that right there, that's the trap. You could suddenly owe tens or even hundreds of thousands of dollars in taxes, all while holding stock you can't even sell yet, with absolutely no cash from a sale to pay that bill. It's a total catch-22. So, With all that in mind, how do you manage this whole process and actually turn your options into real profit? Well, it all comes down to when you sell. The timing of your sale literally determines everything about how you're taxed. Okay, to get that best case scenario, that sweet, low, long-term capital gains tax rate, you have to satisfy two rules, both of them. You have to sell your shares more than 2 years after they were first granted to you, and more than 1 year after you actually exercise them. If you miss either one of those deadlines, even by a day, the tax math changes completely. And the difference we're talking about here is just it's night and day. On one hand, you have a qualifying disposition. That's where you follow both rules. Your profit gets taxed at the much lower capital gains rate. But on the other hand, you have a disqualifying disposition, selling too early, and that can nearly double your tax rate on some of that profit. The bottom line is simple. Being patient can literally save you thousands or even tens of thousands of dollars.
So you've got all these moving pieces, right? When to exercise, this crazy AMT thing, the holding periods. How in the world do you make the right call for you? Well, there's no magic answer. It's all about building a personal strategy that's based on your own unique situation.
Here are the questions you absolutely have to ask yourself. First, how much do you truly believe in this company's future? Second, how big is that bargain element we talked about, the thing that could trigger that nasty AMT? Third, and be honest with yourself, do you actually have the cash on hand to buy the shares and pay a potentially huge tax bill? And finally, how comfortable are you having a huge chunk of your net worth tied up in one single untradeable stock? You know, at the end of the day, just remember this. Don't let the tax tail wag the dog. Sometimes selling early and taking that tax hit actually makes sense if you need the money or you just want to reduce your risk. The goal isn't just about paying the lowest possible tax rate. It's about making the smartest decision for you and your financial goals. Look, incentive stock options are like a complex puzzle. There's opportunity, there's risk, there's a ton of timing involved. But they're not a lottery ticket. They're a game of strategy. And now that you understand the key pieces on the board, exercising, the AMT, holding periods, you are equipped to start building your winning strategy. So the only question left is, how are you going to play?